Stock market returns play a massive role in our investing lives. We spend so much time looking at historical data and fiddling around with our portfolios to try and get the best returns possible. Saying that, times change, and so do market conditions. So, what stock market returns can we expect in the future? Financial forecasts are used to give us some insight. We take the current data that we have and then use them to predict future stock market returns. So today we're going to review some of Vanguard's forward financial forecasts, we'll tell you how they came to their predictions, and then we'll tell you what to do with this information. But before we get to all of that, why do we actually need to worry about what future stock market returns are going to be? Many investors, like myself, like to talk about data, similar to what we're about to do here, but then it all gets rounded off with the same conclusion. Don't change what you're doing, stay invested, and do not panic. Now, I'm not saying that this data is going to change any of that, but it certainly will make you think about your portfolio and general financial planning. Financial forecasts give fairly realistic approximations to what future stock market returns are going to look like, so you should probably listen. If not, we could make incorrect investment decisions by ignoring key information. For example, let's say that you know you need 4% growth for 5 years to reach a certain investing goal that you have. Let's say retirement. If you looked at the average historic returns for bonds, you'd see that it is around 5%. So, based on historical data, you could make the assumption that if you invested in 100% bonds, which would be quite safe, then you'd reach your investing goal. But, as we all know, bonds are not returning anything close to 5% nowadays because of the current market conditions. In fact, bonds are much closer to an average of around 2% over the past few years. This is just one example that shows we need to base our future expectations on the current data that we have. But this doesn't just apply to bonds, it applies to stocks as well. The annualized returns of the S&P 500 from 1871 have been somewhere around 7%. But that's all-time data. Sometimes it's been much more than that, and sometimes it's been much less. From 1930 to 1940, the annualized return was 0.85%. But from 2010 to 2020, the annualized return was 12.06%. Now, I'm not saying that financial forecasts predicted these returns exactly, but you'll see that in some cases, they weren't far off at all. Vanguard, surprise surprise, wrote an article on this topic that I'll make sure to put in the description below. They've developed the Vanguard Capital Markets Model, which they describe as a rigorous and thoughtful forecasting framework that they have honed over the years. So, what does the model tell us? Well, it's not good news. We're due a decade of below average returns for both stocks and bonds. Now again, I just want to make it clear that these are forecasts only. Nobody can see into the future and nobody knows what's really going to happen. But it is still interesting nonetheless. I think that Vanguard would much rather give a realistic forecast of what to expect, instead of lying to people and telling them that we're going to get another record-breaking decade of returns. This is the first graph that is shown. I'll spend some time talking through it just so you know what's actually going on. The graph is mainly made up of two lines. You've got the solid green line and then the dotted black line. The solid green line shows the average annualized returns for the past 10 years to that date. So if you pick the year 2012, the point shows the annualized returns from October 2002 to September 2012. Which was around 7.5%. This is why the green line ends at 2020, because we don't have any more data after that. The dotted black line shows the forecasted annualized returns, which were made 10 years before that date, which is why it goes on to 2031. It is worth mentioning that these returns are for a 60-40 portfolio, which is why the returns may look a little lower than you'd expect. Just remember that a 100% equity portfolio would have higher expected returns. There is also a green shadow that follows the dotted black line, which represents the upper and lower quartiles for the distribution of returns that we could expect. This is here to give Vanguard a bit of a cushion with their approximations. So now that you know how the graph works, let's talk about some things. I first want to point out how accurate Vanguard have been over the years. The predictions have not been 100% correct, as you'd expect, but the general trends have been pretty much spot on. The actual returns don't ever leave the upper and lower quartiles, which is quite impressive. This just shows how strong their predicting powers actually are, and how much we should listen to their low returns warnings. You can see that they almost perfectly called the spike in annualized returns from 2017 to 2018, which is where the line reaches a peak. This is a product of the 2007 and 2008 global financial crisis, which caused a lot of panic in the investing world. Vanguard managed to tune out the noise of all of the doom and gloom in the markets at that time and managed to predict that the markets would bounce back, which they did. Because everybody was panicking, they overestimated how much trouble we were in, but Vanguard looked at the data and made a realistic decision. The prices in the stock market had dropped so low because of the crisis, arguably too low, which means that the future expected returns for this period were higher because everything was at such a bargain price. But after this point in 2018, it's pretty much downhill from there. The future expected returns just keep falling and falling. So, Why is this happening? This all stems from the current market conditions that we are witnessing now. Ultra low interest rates and high valuations in the US equity market. The low interest rates mean that bond returns have been pitiful over the past few years, and they're probably going to stay that way for a while. Then, the high valuations in the US markets, which make up around 60% of global markets, have meant that future expected returns are lower. Vanguard have two more graphs just below, which shows the same data for US equities and non-US equities. Again, the general shapes aren't actually far off, but it's the magnitude of the overperformance for the US and the underperformance for non-US equities that really stands out. US equities blew away all expectations by a mile, with the most recent average annualized 10-year return of around 13.4%. On the other side, we have non-US equities, which have had a recent average of around 4%. But the key thing to note is the effect that this has had on the future expected stock market returns for both categories. The US expected returns fall to an all-time low in 2031, down to a median average of 3.1%. The non-US equities remain somewhat average, at around 6.1%. This is all related to the balancing effect that the stock market seems to have. US equities have outperformed for over a decade now, but we just can't expect this to happen in the future. The key word there is expect. Nobody is saying that it can't happen, we just can't expect it to happen. It's weird, I know. Because the US has performed so well recently, the valuations are reaching near all-time highs. This graph shows the price to expense ratio of the S&P 500 from when records began. We're just behind the second highest point in history, with the top 2 points being the dot-com bubble and then the global financial crisis. The price that we are currently paying for US equities is astronomical. Some would say it's pretty ridiculous. The problem is, when you pay a high price for equities, the future expected returns decrease. To help get your head around this, I'll give a little example. Imagine two equities that are identical in every single way. All the fundamentals are the same, apart from the price. One of the stocks is worth $1 and the other stock is worth $2. Remember, they're the exact same, but for whatever reason, some people are paying a higher price for one of the stocks than the other. In 10 years' time, you go to sell these stocks. The cheaper stock has grown to $3, which is a 200% profit. However, by this point, the market has cottoned on to the mispricing that's been going on. So the second stock also rises to $3, which is just 50% profit. By paying a higher price for the second stock, you essentially had less room for growth because it was already so overvalued, even though it was the exact same as the first stock. Well, the problem that we're facing now is that the entire US equity market is the second stock that we were just talking about. Let's say you were to buy a single US equity stock in 2018 and you paid $1 for it. That same stock today, which is not changed whatsoever, is worth $1.70, which means you have to pay 70% more. There isn't a fundamental reason for this happening. There's nothing to do with the cash flows or the revenues. We're just paying a higher price for the same stocks. Now, this is something that is bound to happen over time, with asset inflation, and there's a few other factors that play into it as well. But the spike that we're seeing right now in the US, it just doesn't seem right. And to make it clear, this is not me saying don't invest in the US markets, because a large allocation of my portfolio is in the US too. I'm just talking about the data. On the other side of things, non-US equities currently have lower PE ratios. This means that we're getting more of a bargain. Because of this, there is more room for future growth, and the future expected returns are higher. But again, I just want to make it clear that these are forecasts only. I'm not saying that US equities are going to tank, because nobody can know that for sure. Either way though, the key takeaway is that the next decade of forecasted stock market returns is not looking so good. But what can we do with this information? Well, Vanguard suggests 4 reasonable solutions that we should consider to combat this bad news. The first of which is for us to save more money. Now, this may seem a bit obvious, but at the same time, that doesn't mean we should ignore it. If our future stock market returns are expected to be lower, then that means we're going to have to invest more money to counterbalance that. We should always be aiming to save as much as possible anyway, but it's only going to become more and more important over time. The more money that we put in, the more money that we're going to get out. The second point is to reduce our expenses, which will do 2 things. Firstly, it will mean that we save more money, which of course ties back into the first solution. Secondly, it will mean that we may be able to reduce our future investing goals. If we can start to live less expensive lifestyles, hopefully without reducing our happiness, then we can reduce the amount of money that we need to save. The third solution is for us to delay our investing goals. Now yeah, I get it. This may be a pretty saddening solution, but it's a reality that we may have to face. With our returns possibly being lower in the future, it may take more time and more money to get to where we want to be. So if we can push our investing goals back a little, then we will be able to invest more towards those goals. If we're talking about retirement, then there's a sort of double effect. If you push the goal back, then there's more time for your money to compound, and then also you're going to have a few extra years working, which means that you'll be saving more money. The final solution that they suggest is for us to adjust our equity and bond allocation where appropriate. Now, this is where I have to chuck in the disclaimer that I'm not a financial advisor, so if you do want financial advice tailored to your own circumstances, then seek professional help. But the key point is that bond returns are painfully low. So if you can stomach it, then increasing your equity allocation could mean that you get higher returns over the next decade. Remember that the graphs from earlier showed a 60-40 portfolio. A 100% equity portfolio would have higher expected returns. Of course though, that would carry much more risk, so it's not a decision that you should take lightly. Finally, I'm going to round this video off in the same way that Vanguard did with their article, with a quote from the late Jack Bogle. Through all of history, investments have been subject to a sort of law of gravity. What goes up must come down, and oddly enough, what goes down must go up. I'll see you next time, guys.